The Fiscal Affairs Department of the International Monetary Fund has just published its latest assessment of global fiscal developments.
Our analysis suggests that fiscal risks are abating somewhat but remain elevated in advanced economies. In emerging market and low-income economies, vulnerabilities are rising, although from moderate levels.
In advanced economies, fiscal consolidation since 2010 and recent policy moves have brought the average cyclically adjusted deficit, which measures a government fiscal deficit adjusted for changes in economic activities, down to 3.5% of GDP. Consolidation will continue in 2014, but at a more gradual pace, with a lesser drag on growth. Despite these efforts, the average debt ratio is at an historical high and will remain above 100% of GDP by 2019.
Emerging market economies initially weathered the crisis well, but now face more challenging circumstances, as evidenced by the recent bouts of market turmoil. In addition, those emerging economies with higher non-resident debt holdings may see sharper increases in domestic interest rates as liquidity conditions in advanced countries tighten.
This chart shows that non-residents hold around 1/3 of the total emerging market government debt, and in recent years there has been a shift towards local currency debt holdings.
Fiscal space also declined in low-income countries, and in half of them debt ratios will keep increasing as revenue mobilization is lagging fast spending growth. In advanced economies, the top priority remains the design and implementation of credible medium-term consolidation plans to bring debt ratios to safer levels. Emerging market countries with large debt and most susceptible to market volatility should take decisive measures to rein in deficits. In other emerging market and low-income economies, fiscal reforms are also needed, although perhaps less urgently, to rebuild fiscal space and boost potential growth. Expenditure reform has a key role to play in strategies to strengthen fiscal positions. In fact, advanced economies have already begun shifting the composition of their fiscal consolidation plans towards expenditure measures. Emerging and developing economies are facing growing demands for the provision of better public services. The challenge for policymakers in these countries is to ensure the sustainability of expenditure programs in an efficient and equitable manner. Although the forms and sequencing of spending reforms will vary across countries, general principles do stand out. Countries should avoid across-the-board expenditure cuts and seek to ensure the sustainability of social spending and public wage bill, the main items in most governments' budget. In addition, countries should mobilize institutional and political support to achieve efficiency gains while preserving equity. Another important finding is the decline in capital stock in advanced and developing economies.
This could have important adverse implications for growth going forward, and corrective measures are needed through stepped-up investment by the public sector, the private sector, or both.